All right, everyone, welcome to today's session. We're going to go over how to avoid and how to use pending orders properly. So in this situation, this was basically a trade that we took earlier that went wrong, and we now realize that we should have used a different strategy on this specific trade. It was 1 out of 7 trades that went wrong, but how we can avoid this is actually using pending orders. So what I'm going to do is I'm on the 15-minute chart. I'm actually going to stretch this out quite a bit. But basically what you do when you're wanting to use the strategy of pending orders is you want to find a certain area. Let me just show you an example. A certain area where the market has not reached for a long time. So in this instance, I would have put a line right here. And then in the other instance where the market would be on the other side, and as you can see, that would be about right here. Okay? So this middle would be where the market was when we were looking at this chart. I would put a line right up here and down here, which basically, as you can see in the zone, is where the market has not been for quite a while. What you would do would be placing a pending order on each side. Let me just write this out for you. You would be placing a buy stop up here, okay, right here. And you'd also be placing what's called a sell stop below it, right here on this line. Now, what these basically mean when you have a sell stop or a buy stop is once the market touches either this point or this point, it is going to activate the buy or the sell. So if it goes up, it's going to activate a buy and hoping that the market will continue in that direction. The sell is the same thing. If it hit this, it would continue in that direction. What people use this for is, again, yesterday, I can almost guarantee there was a big news, a red news folder that was coming out, right? So we had right here on TradingView, it would have shown a big red news folder saying, hey, watch out, something volatile is going to happen. This is also the perfect strategy to use while if you have big news, this is how you trade and you don't do market execution. So why this is effective is because right now, as you can see, the market goes into consolidation almost always before news or before a big movement in any way, shape, or form. It does a consolidation. What you're doing is putting your orders on the borders of the consolidation. So if it breaks out, again, as you guys have been taught in my training, if it creates a new high, it's probably going to create higher highs and higher lows, right? And as you can see on this one, we can actually see this one was kind of signifying to us, it is creating higher lows and it also is creating higher highs, right? So this was indicating this whole time that it was going to be a buy if you were looking on the basic fundamentals of it. But to be extra careful and safe, put your pending orders here and here. So in case the market spiked down, right, if it went up here and then spiked down, don't worry, you get entered there and you will at least catch from here to here in the pips. If we would have entered a buy stop here before it spiked and before the news, so whatever way it happens, as soon as it hits one, we close the other, right, and let ride that one. If we would have done that, you could see right here, we would have caught just off that one candle about 30 pips, right? So this is a little method you can use for news or for whenever it's in any type of consolidation. Here's another example. It was in a consolidation zone. Let me just draw it out, right? You can call this the consolidation zone, okay? What you could have done is very simply put a pending order right here and right here, whichever way it goes. And what did it do? It spiked up from here. Technically, it was over here was where the consolidation was. But see, it spiked up and continued. So you would have been a profitable trade right there, right? You can do this for any time you're uncertain where you're like, okay, I know it's going to go somewhere. I am just not certain if it's going to break or not. Same thing with these points right here. If we were going to do this market right here, if you were trading around here and you said, I don't know what it's going to do, right? This was the box you were entered in. You could put a pending right below here, right? So if it breaks the low that it's never broken before, obviously it's going to continue down more. So you can catch that with a pending sell stop here or a pending buy stop here. And what did it do? As you can see how the market reacted, right? It went down, up, down, and then finally hit that and continued. I would usually do, when people ask what space, Daniel, should I put this pending? I'd put it around 5 pips from your little box or from your consolidation zone in either direction, right? But I can show you again. I can do this all day. Here's another one, right? So you have a box right here, right? So we have a box right here, right? And if you do 5 pips, 5 pips is around here, right? And then the 5 pips on the bottom around here. What would you done? Look, you would have caught some pips right there, right? So, and then once it gets down there into this box and you see another consolidation to here, you can do the same thing, right? Another one right here and another one right here. I'm just going to delete these old, right? You can do it there and there. And same thing, you would have continuing getting profits. So this is a very, very useful tool for beginners, and it's something that I would recommend you guys to use if you are one of those people that are not certain on where to enter. Again, you know, those that are really skilled, they might enter the W right here, right? And they might catch more pips than you because you're entering right here. But at the end of the day, you are being more secure, while more advanced traders, that's why it's riskier to trade here. We call it more advanced trade because, again, there's not as much confirmation as when it does there, right? So this is a little lesson to use on pendings. And again, the opposite way that you could do pendings, as I'm going to now show you, is if you want to do it the way you're not waiting for consolidation, but it's pre-consolidation, of course, you can do buy stops and sell stops. So here's another example for that. Let's say on right here, of course, we know that it's creating highs, and somewhere around here is that zone where it's going to drop, right? Right around here, we've seen that. So if we put our zone, our resistance zone here, right, and go further into market where it's at, around here when it gets this point, so you could be putting maybe around here a sell limit. So as the market was rising in this point, so let me just consolidate down. As the market was rising, you know that around this zone, right, it's going to drop. So you could have buy limit or sell limits there. So once it rose and touched it, you already automatically entered and caught that trade. Okay, so you can be doing that for different things as well. Maybe even again right here, right? So as you saw the market go down and down again like that, right? Maybe you're waiting for a W to happen. So you put your buy limit maybe right here, right? Boom. And then, of course, once it spiked down and touched it there, it activated and you would have caught that trade. You can do this over and over again within the market. Here's another example, right? When this did this big drop, here was the last high and it dropped. So when you were waiting for the next sell to get back in, you would obviously put it at this line, right? And what happened as the market rose up, it hit that, would have activated your pending sell and continued down if you had a sell limit. So these are very useful tools when you know the certain price point in the market, and this is what we call price action trading, is when you see a certain price in the market where there's always action, it always moves in a certain direction. Using buy stops, sell stops, or buy limits and sell limits are the most useful way, and you can therefore plan ahead in the future for the trades you're going to take. You can have your lines predetermined like we have here, and as the market continues, right, when the market gets back down to here, we would most likely have, right, a buy limit going. So it'll go down, touch, and then rise back up, and we catch it. And these are ways to make your business and your trading a little bit more hands-free. You can place a few pending orders everywhere across a few trades and markets, and then just walk away for the day because everything's automated and set in stone for you already. So this is again one of the best ways to trade if you do not like to do the waiting around and doing market execution. I hope you guys enjoyed this training, and I hope you have a good day.